Most retail traders are taught from day one that the higher the reward to risk ratio, the better the strategy, and every YouTube guru reinforces the same seductive idea that you should only take trades where you risk $1 to make 3, that you should always hunt for those perfect 3.1 setups that supposedly allow you to win only 25% of the time and still break even, making it sound like the smartest, safest, most mathematically elegant approach to trading. But the truth behind this advice collapses the moment you actually experience real losses, real account drawdowns, real psychological pressure, and real uncertainty. Because the problem with 3-1 RR is not the math at all. The math is fine. The math is attractive. The math looks like the Holy Grail when written on paper. But trading is not a paper exercise, and your brain does not operate according to clean equations when money is on the line. And this is where the real danger hides. A 3.1 RR strategy forces long losing streaks, forces low win rates, forces emotional instability, forces hesitation, forces doubt, forces impatience, and forces most retail traders to sabotage themselves long before the math can play out. And this is why the 1.1 RR approach quietly outperforms for retail traders, even though it sounds less intelligent, even though it sounds too simple, even though it sounds not professional, and even though influencers on the internet dismiss it as weak or amateur. Because while they are busy trying to look smart, you are trying to survive the psychological battlefield of trading, and survival always beats intellectual ego. A 1.1 RR structure creates emotional stability, creates shorter drawdowns, creates higher win rates, creates smoother equity curves, creates psychological comfort, and creates the mental consistency required to follow one system for months and years, not days and weeks. And this is the real reason it beats 3.1 for retail traders. Because the game is not about winning the theoretical math. The game is about controlling the human brain's biological tendencies under stress. Let's go deeper into why this happens. When you trade a 3.1 RR setup, the natural win rate significantly drops because targets are further. Volatility is unpredictable. Markets breathe unpredictably. Structure changes mid-trend. Liquidity sweeps happen constantly, and price rarely travels in a perfectly clean straight line toward your faraway take profit. Instead, you get stopped out multiple times before the big move finally comes. And this creates something catastrophic, a series of losses that feels like personal failure. Most retail traders cannot handle 6 or 7 losses in a row, even if the math says it's normal, and their psychology collapses after the 3rd or 4th loss, creating frustration, fear, doubt, hesitation, and emotional burnout, causing the trader to either stop taking setups altogether or to abandon the system entirely and start experimenting with random trades, revenge trades, oversized trades, or micromanaging every candle, all of which destroy the mathematical edge they thought they had. Meanwhile, the 1.1 trader experiences something dramatically different. Shorter losses, shorter drawdowns, shorter frustration cycles, fewer emotional scars, more dopamine reinforcement from frequent wins, more confidence, more internal trust in their system, and this consistent psychological reinforcement is what creates a long-term trader who can actually follow a plan. Because consistency is not built from big winners. It is built from mental comfort, emotional stability, and the ability to show up day after day without collapsing emotionally. Another critical issue is probability distribution. A 3.1 RR strategy depends on catching rare extended moves. And rare extended moves require patience, time, volatility alignment, and favorable market conditions, which don't happen every day. And this forces the trader to either wait endlessly, which retail traders are terrible at, or to force trades that look like they could run, but don't actually have the conditions to reach 3R. So the retail trader ends up taking lower quality setups and gets punished for it, reinforcing the belief that the market is against them. But a 1.1 RR setup does not require rare moves. It requires normal, natural price behavior that happens hundreds of times per month across all markets. And this abundance of valid opportunities makes it easy to maintain discipline because the trader does not feel desperate, does not feel bored, does not feel forced to chase setups, and does not feel psychological pressure to stretch their patience or accuracy. A 3-1 system also creates equity cliffs, meaning your equity curve experiences long flat periods followed by sudden jumps. But the flat periods are torture because your brain interprets a long period without progress as failure, even if the system is working properly. Most traders cannot tolerate flat equity curves, so they modify the system prematurely, adding more filters, adding more indicators, adding more rules, or trying to optimize entries, all of which destroy any statistical advantage they originally had. In contrast, a 1.1 equity curve grows more smoothly, more steadily, with fewer violent swings, because wins are more frequent and losses are smaller relative to the emotional pain they create. And this smoothness is essential for psychological sustainability. Trading is not a math competition. It is a psychological endurance test, and the winner is the trader who can follow one set of rules the longest without emotional collapse. That is the hidden edge of 1.1. The human brain prefers consistency, not brilliance. It prefers stability, not excitement. It prefers frequent reinforcement, not rare jackpots. It prefers gradual progress, not volatility. This is why casinos make money. This is why slot machines use small, frequent rewards instead of rare, huge payouts. The human brain is engineered to stay engaged when rewards are consistent. The same applies to trading. A 3.1 system gives you a dopamine reward once every 10 trades. A 1.1 system gives it to you 5 or 6 times out of 10 trades. Which trader will feel more motivated? Which will feel more confident? Which will stick to the plan? Which will stop sabotaging themselves? The answer is obvious. And that is the foundation of why 1.1 RR quietly outperforms for retail traders. Not because the math is better, but because the psychology is survivable. Trading is not an IQ game. It is a behavioral game. And behavioral games are won by reducing fear, reducing anxiety, reducing emotional weight, and reducing cognitive overload, not by flexing mathematically impressive ratios. A 3.1 ratio is mathematically attractive, but psychologically hostile. A 1.1 ratio is mathematically simple, but psychologically supportive. And the psychological dimension is what decides whether you trade like a robot or a human. Humans break under pressure. Humans avoid pain. Humans seek reinforcement. Humans lose discipline when frustrated. Humans chase when desperate. Humans freeze when uncertain. A trading strategy must be designed not for mathematical perfection, but for human imperfection. And a 1.1 RR framework is the most psychologically compatible structure for the average retail trader because it aligns with real human behavior instead of fighting against it. When your strategy works with your psychology, instead of against it, you become consistent. And consistency is the only true path to long-term profitability. This is why the traders who switch from 3.1 RR to 1.1 RR often report an immediate sense of relief, clarity, calmness, and confidence, because they are no longer fighting against the market's natural structure or their own biological limits. And they begin to realize that the purpose of trading is not to chase big rewards, but to create a stable, repeatable process that compounds over time. And compounding does not care whether your RR is 1.1 or 3.1. Compounding only cares whether you can keep the equity curve upward without blowing up, freezing emotionally, or abandoning the system. And this is precisely why retail traders thrive when they adopt 1.1, because they can finally execute consistently without hesitation, without panic, without second-guessing, and without forcing the market to deliver huge moves. Instead, working with normal market swings that occur naturally and frequently. The second powerful reason 1.1 RR beats 3.1 for retail traders is microstructure reality. Market makers, liquidity providers, and algorithmic engines operate in ranges, rotations, and liquid zones. And most intraday moves are mean reverting rather than trend extending, which means price rotates frequently between equal pockets of liquidity, creating abundant opportunities to capture 1R profits, but far fewer opportunities to travel 3R distances before reversing. Retail traders aiming for 3R often find their targets placed far beyond natural liquidity pockets, meaning price might move halfway, stall, and reverse, hitting their stop loss even after behaving correctly. This creates a deeply painful psychological loop. The trader was right, but still lost money because their target was unrealistic relative to the structure. After this happens repeatedly, frustration compounds and confidence erodes. Meanwhile, the 1.1 trader captures the natural rotation and exits before structural exhaustion, taking profit inside the normal breathing pattern of price instead of demanding abnormal extension. A 1R target is structurally aligned with how price moves, but a 3R target often requires a perfect sequence of volatility, momentum, time of day alignment, and sentiment continuation, and many retail traders lack the filters, backtesting tools, and experience to identify these rare windows consistently. Another hidden problem is emotional volatility. A 3.1 RR strategy demands that you risk the same amount as a 1.1 strategy, but win far less frequently, and this creates an emotional imbalance between effort and reward. You sit through multiple losing trades in a row to finally catch one big winner, but the emotional damage of the losing streak often outweighs the emotional benefit of the win, meaning your psychology becomes net negative even when your account is net positive. A trader cannot sustain this emotional deficit. Humans are not machines. And the problem becomes much worse when dealing with real money instead of demo accounts. In a 3.1 system, every loss feels heavy because you know another one might follow, and then another one, and then maybe another 3 before you finally catch a big winner. This expectation of pain creates anticipatory anxiety. The mind begins fearing the next loss even before taking the next trade, and this leads to hesitation, late entries, premature exits, avoiding valid setups, and breaking rules, all of which destroy the statistical edge. When the mind fears execution, the system dies. But in a 1-1 system, each loss feels manageable because you know the next win is statistically likely to come soon. So your brain doesn't panic, doesn't catastrophize, doesn't overreact, and doesn't sabotage your decisions. You execute the next trade as if nothing happened. This psychological neutrality is priceless. Psychological neutrality is the state of mind where you can follow your system without interpreting every outcome as a personal attack from the market. This is how professional traders think. They don't attach emotion to individual trades. They see every trade as one iteration in a large statistical distribution, not as a reflection of their identity. Retail traders, however, are emotional creatures, often attaching their self-worth to outcomes. And a 3.1 RR system punishes this tendency brutally. It invites emotional attachment because each win is rare and special. So the trader clings harder to each setup, increasing the emotional weight, which increases stress, which increases fear of loss, which increases hesitation, which increases inconsistency. A 1.1 system removes this emotional weight, making each trade feel routine rather than monumental. Routine is the mother of consistency. Another major advantage of 1.1 RR is time efficiency. A 3.1 system requires the trader to monitor trades longer, exposing them to more market noise, more whipsaws, more reversals, and more decisions where emotional impulses can interfere. The longer a trader watches a trade, the more likely they are to interfere with it. A 1.1 target gets hit more quickly, shortening trade duration reducing screen time, and minimizing the window for emotional sabotage. Less time in the market means less opportunity for mistakes. Less opportunity for mistakes means better performance, even if the mathematical expectancy seems simpler. And that's the deepest truth here. Trading performance is not determined by the mathematical side of the strategy, but by the behavioral side. A mediocre system executed with discipline will outperform a mathematically superior system executed emotionally. A 1.1 setup aligns with human behavior. A 3.1 setup fights it. This is why professional firms do not obsess over RR the way retail traders do. They optimize for win rate stability, volatility adaptation, execution repeatability, liquidity conditions, and psychological sustainability, not for big flashy RR numbers. The market does not reward traders who look smart. It rewards traders who behave consistently. Consistency requires emotional safety. Emotional safety emerges from frequent reinforcement. Frequent reinforcement emerges from realistic targets. Realistic targets emerge from 1.1 RR setups, not oversized distant targets fabricated in motivational videos. And here is something almost nobody talks about. A 3.1 RR system creates huge variance in equity, which is catastrophic for compounding. A trader who goes through massive drawdowns before hitting big winners slows the compounding curve dramatically because recovering from drawdowns requires exponential gains. A 1.1 system prevents deep drawdowns by smoothing the equity line, allowing compounding to work continuously with fewer interruptions. In trading, avoiding large drawdowns is far more important than producing large wins. A trader with small, consistent wins will outperform a trader with huge wins and huge losses simply because the consistent trader stays alive longer. Survival is the real edge. Survival creates the opportunity for compounding. Compounding creates capital growth. Capital growth is the only path to financial freedom. None of this is achieved through the flashy theory of high RR strategies for retail traders. All of it is achieved through the boring, humble, psychologically stable 1.1 approach. And perhaps the most important factor is identity transformation. Traders who use 1.1 RR stop thinking like gamblers and start thinking like operators. They stop hunting jackpots and start executing processes. They stop caring about individual trades and start caring about long-term distributions. They stop panicking after losses and start trusting the system. They stop forcing the market to deliver big moves and start flowing with its natural rhythm. They stop emotional trading and begin rational execution. This identity shift is what separates profitable traders from the 90% who fail. And the irony is that most traders will never experience this shift because they are stuck chasing the illusion that high RR equals high professionalism. Meanwhile, the reality is the exact opposite. The traders who win long-term are those who choose the psychologically sustainable path over the intellectually glamorous one. 1.1 RR is that path, not because it's mathematically superior, but because it's psychologically survivable. And in trading, the strategy you can survive is the strategy you can scale. The strategy you can scale is the strategy that builds wealth. The strategy that builds wealth is the one you can execute consistently without breaking down emotionally. That is the simple, brutal truth the trading world refuses to admit. And that is why 1.1 RR beats 3.1 RR for retail traders. Not in theory, but in reality, where psychology decides everything.